Who do you think will sort of end up winning this tariff war that Trump has now initiated? Is there any winners?
Yeah, that's a great question. I mean, it's very clear that the most obvious loser right now, and I think that's a little bit underreported, is Temu. Because what's still in place is even though most of the tariffs against China has been paused, there's the smaller transfers of goods. And I don't remember the exact. I think it's $800 perhaps, or perhaps it's 8,000. But anyway, smaller individual shipments of goods are still subject to very, very large tariffs, and that has hurt Temu extensively.
Do you think this is part of a larger plan of bringing industrial production back to the U.S. and sort of revive the Rust Belt?
Yeah. And that is mostly a political discourse, because from a financial and economic perspective, I mean, bringing back these jobs, they're not going to come back in the form of jobs. It might be that the robots work in the US rather than in China. I think what you need to see the tariffs as if you're trying to be constructive here, is that it's essentially a tax on multinational corporations producing companies, producing goods where it's cheap and selling it where it's expensive.
Hello, welcome to QuantPod. This is actually our first international guest, Mikkel Rosenvold. Welcome aboard.
Thank you.
Thank
Pleasure
you.
being here.
Yeah. You're a macro analyst and a geopolitical expert from Steno Research. Would you like to give the audience a brief introduction to yourself?
Yes, absolutely. So, yes, my name is Mikkel. I come from Denmark, so that's why we're doing this in English. My Finnish is not that good, so we're happy we could do that. Together with my partner Andreas, I run the company called Steno Research. We've been doing macroeconomical and geopolitical research for the past couple of years. We are pivoting the business into running our own hedge fund now called Asgard Steno. So we're spending a bit more time on that, but still doing a lot of analysis. That's obviously relevant in both cases. So my part of the business is mainly geopolitics. So that comes in when we've done all our data analysis and we've made all our generated all our trade signals. We come to the decision layer, and that's usually where geopolitics plays in. We can get back to some examples for that, but that's my job.
Sounds quite interesting. To kick it off, maybe you want to give the audience a brief sort of macro overview. What are the current trends and what does the market look like?
So, I mean, we've had quite the crazy 2025. We launched the fund on December 1st, and I mean, whenever you're doing either research or running a fund out of Europe, you're used to, you do your trades, and then you go home, you have dinner, and sometimes you can sleep. We haven't had too much of that. That's mainly because of Trump. We have to admit that. That is the big theme here. So every time we thought we had the right positioning, we'd done the analysis, we'd done some podcasts, went home for the evening in Europe, something happened, and we had to throw it all away. And that's the new normal. You have to react very, very quickly to things when you're running a hedge fund or doing live research. So we've been doing that. So obviously, the big volatility that's come from the new Trump administration is obviously the big topic. I think we've seen so many U-turns that it's hard to keep track of. But now it seems that we are in the position where the administration has decided to outgrow the deficit. That's the strategy now, and I think that's the main headline you need to be focused on, because if you go back 2 months, it was a matter of tariffs and Doge managing the deficit or bringing down the deficit. It's doing a little bit, and it's working somewhat, but it's not making a real dent in the U.S. deficit. So I think the decision of Trump and Bessent to pivot to outgrowing the deficit is a major one, and a major market theme to focus on for the rest of 2025, because it's most likely going to continue into the midterm elections.
Do you think it's a realistic strategy to outgrow the deficit, considering that there's still the big beautiful bill, as he likes to say?
Yeah, it's coming up, and that's very much a part of it. And I think that's the final piece of evidence. One thing is the Elon Musk Trump breakup, and very clearly the Doge project being prioritized down, but the big beautiful bill, is to me evidence that this is now the strategy. I thought when Trump was inaugurated, he talked about a new golden age for America. I thought this was what we were going to get, that they were going to try and fire on all cylinders and grow the economy out of the troubles. But then we had sort of a shift away from that. You had a lot of talk about, this is going to hurt for a couple of years and then it's going to be good. Now it seems like they're back to we need to outgrow this, and it's spectacular, and it's going to be defining for markets, I think, throughout 2025.
From a market actor's point of view, how significant is this sort of geopolitical aspect in terms of your trading strategy, and especially with Trump, all the uncertainty? You know, you might wake up and he's tweeting the markets are going to rally, or he's tweeting that he's putting 120% tariffs on whatever country he has in sight.
Our fund has a very data-driven, AI-driven strategy, and it's we have a very structured investment strategy and process. So we always try to remind ourselves that what we're good at is deciphering the macro picture with our data models. Our data models cannot predict Donald Trump's behavior or his decisions. So we try as much as possible to steer away from that, or to at least be very, very clear about how we're implementing this into our decisions. On the other hand, there are some trades to be made on that. We can get back to copper, for instance, and other stuff. So obviously it plays into our analysis of the macro picture, but sort of from day to day to gamble on these decisions, that would be guesswork, and that's not what we're in business for.
Who do you think will sort of end up winning this tariff war that Trump has now initiated? Is there any winners?
Yeah, that's a great question. I mean, it's very clear that the most obvious loser right now, and I think that's a little bit underreported, is Temu. Because what's still in place is even though most of the tariffs against China has been paused, there's the smaller transfers of goods. And I don't remember the exact. I think it's $800, perhaps, or perhaps it's $8,000. But anyway, smaller individual shipments of goods are still subject to very, very large tariffs, and that has hurt Temu extensively. It's their entire business model is to sell directly and ship directly to the consumer from China. So they've lost immensely on that. That's probably going to be rectified. It's probably going to be part of the talks, but that's a huge factor. It's been good to be investing in the lower end of U.S. Retail sales. Anyway, that was Lucy. You asked about the big winner here. Yep. I mean, I think China has stood their ground very, very well so far. The EU as well. They've been very, very patient, and now they have the card that Trump he can't be sure that he can get these tariff plans through the U.S. legal system. And that means why on earth should China or U.S. or the EU jump into trade deals with the U.S. when they know that it's a likely scenario that he will get overturned in the courts. So I think it's very, very hard to see the U.S. as winners of this. They might be generating some government income from the tariffs. They might be able to spin that as a win or to gain some leverage, but not nearly to the extent that Trump was expecting.
Yeah. Do you think this is part of a larger plan of bringing industrial production back to the US and sort of revive the Rust Belt?
Yeah, and that is mostly a political discourse, because from a financial and economic perspective, I mean, bringing back these jobs, they're not going to come back in the form of jobs. It might be that the robots work in the US rather than in China. I think what you need to see the tariffs as if you're trying to be constructive here, is that it's essentially a tax on multinational corporations producing companies producing goods where it's cheap and selling it where it's expensive. That's not something you would expect to hear from a Republican president. That sounds more like center-left or left-leaning politics, to be frank. He's also prone to left-wing rhetoric against Walmart, for instance. He argued that Walmart should eat the tariffs and should act like that. So that's, I mean, it's we have to get used to a whole other way of thinking. And I think the politics of this, the optics of this, plays in very, very well with Trump's electorate. And that's what we have to remember, that it's very, very popular to stand up for America, to stand up for these jobs, even though they're not really coming back.
Yeah. What about financial tightening? I would assume that this sort of budget deficit was part of the Doge plan. Let's cut out all the extra spending. Let's bring the budget back to sort of a surplus, if that's even possible. The current debt is somewhere around 37 trillion, I believe. with the interest rates going sort of upwards, at least the demand for the bond has been sort of weak, which leads them to increasing the interest rates. Is this sort of a big existential risk from the US point of view?
It is. I mean, again, if you try to be positive, and if you look at the Mar-a-Lago court and Bessent's plan, he wanted to bring down oil prices. He's done that. They're quite low levels. And Saudi Arabia is actively engaged in a price war, pumping out oil. They wanted to bring down the dollar, which I think was the key point here. They've managed to do so. And I think it's actually could also be in the interest of China and other counterparties to keep the dollar at relatively low levels, perhaps even lower. At least in the medium to long term. So I think they've accomplished that. The final part is to bring down interest rates, and that's looking very, very, very tricky right now. It's looking very, very tricky because investors are increasingly skeptical about the outlook for the US deficit. Many are interpreting this as a sort of an ongoing debasement of the dollar. So it's that's going to be the tricky part, and it's going to be very, very very, very tricky to deal with for the US government in coming months and years.
Before we go into more detail in terms of the yield curves and this kind of stuff, just in general, the geopolitical uncertainty, how has this sort of global conflicts that have been rising in the past few years, how is that sort of affecting your investment thesis?
Hugely so. I mean, I'm overall, my thesis is that we're in the middle of a technological revolution with AI. So if nothing else is broken, you should be long tech and long crypto. That's my very base. I know this is shortcuts a lot, but when something is wrong, it's very often geopolitics or politics that's involved in it. So what we've seen over the past 5 years is that geopolitics, mainly, of course, the war in Ukraine, the pandemic, the reaction to that, but also the conflicts in the Middle East are influencing the global economy massively. And so geopolitics is back. That's okay. I'm a geopolitical advisor. I should, I would always push for that, but I think it's evident that it's back like it was in the 70s and 80s, especially with the oil crisis and everything. It's back as an agenda. It's something you need to stay on top of as an investor.
Yep. What is the significance of, we saw the Japan yield curve and interest rates spiking quite significantly. This is probably going to break the traditional yen carry trade. Does that have a global impact?
Yes, it does, because it affects the willingness of the Japanese investor to invest in foreign bonds, and that I mean, if they take off way fewer European and US bonds, that's a big issue. They used to be a very big purchaser of that, so that could have global ramifications. I think almost all central banks are right now, contemplating what to do about the long end of the yield curve and the ongoing loss of credibility, perhaps a lot of lack of trust in these organizations to stabilize the economy with the deficits we're seeing around the globe. So there are some real difficulties for central banks, and they're really grasping at how to manage this. Yeah.
Do you see any systematic risk building up in the bond market?
I don't think so. We began to see that after the Liberation Day. And I think that was one of the triggering points. And that's one lesson that we did learn, was that we had Liberation Day for the first 2 or 3 days. If you remember, stock markets went crazy. Trump was cool about that. So, okay, that's passing over. Once it began to reach into bond markets, then they reacted. And then they put on, they delayed and everything. And I think that because that's the point where it went from being a stock crisis to a financial crisis. And that was sort of a red line, it seemed, for the US government. So I think they're very aware that there are some red lines. We need to keep the bond market working and the money market working. So that gave me a little bit of, what would you say, comfort. That it seemed like at that point he let Scott Bessent dictate what's happening, and that's comforting.
Yeah. But in overall, I think we touched upon this in the previous podcast as well. Do you see US dollar sort of losing its reserve currency status, or?
Very slowly so, if at all. I mean, it's very hard to see an alternative, because is the Chinese yuan an alternative? No, it doesn't have the characteristics, the stability, the transparency that you need for that. On the other hand, you've had, and I think the US government is very, very acutely aware of this, seizure of Russian financial assets and gold reserve, etc., after the invasion was a major hit to the credibility of the dollar-based system. That's also why they've been so reluctant to allow, especially the European countries, to not only freeze but to seize these funds that are currently frozen, because it's something that is interpreted all across the globe, not in Europe, but in Africa, and Asia, and Latin America, that if you're leading a country that's probably not on the best terms with the US, but you're still engaged in the dollar-based system, because who isn't? That's a major concern. That has led many people to say, okay, we need to have our old gold reserves underneath the military base. That's driven a lot of the upside we've seen in gold over the past years. And those developments the US needs to be very, very careful about. We've also seen the impotency of the US military to solve the Red Sea crisis. I mean, it's incredible if you think about it. We built the Suez Canal in the 19th century. It solved the way around Africa that we had been using for 200 years. Major historical event. And now that's more or less shut off to large amounts of shipping. It's a major event. It's gone on for a year and a half almost. And the US has been unable to fix the situation. They've sent one warship after the other down there, but they've been unable to secure the trade lanes that should support the dollar-based system. So you always have these tweets of, what's really backing the US dollar? And then you get a picture of a couple of aircraft carriers. Well, do they work at that? Can they actually keep trades flows going? So there are a lot of questions, but again, I don't really see an alternative in the way of being a global reserve currency. However, it's obviously leading investors into gold and into Bitcoin, and that's something you can leverage as an investor.
All right, you don't see the BRICS countries sort of forming a coalition. And another interesting idea, sort of more from the crypto space, was what Libra was doing back in the days, this Facebook project, creating a stable coin that would be a basket of all the national currencies. So therefore, de facto becomes sort of the reserve currency.
I think some elements or some facets of being a reserve currency will move in that direction, will move to Bitcoin, will move to yuan and other currencies. And Russia is doing a lot of its foreign trade in yuan or in directly good-to-good basis. I'm still having a hard time seeing the one alternative to this. So I think it's going to be diversified. I think people are going to look to diversify their holdings. A lot of countries are already doing this. A lot of governments are they're not directly buying Bitcoin, but whenever they're seizing Bitcoin, they're keeping very tight hold of it because they know how strategic that might be in the future. So I think we are slowly seeing a diversification of the reserve currency system, but a direct replacement of all of the dollar, I can't see that right now.
Okay, fair enough. Before we started recording, you mentioned that the commodities is also of an interest to your investment strategy, specifically copper. Why?
We're looking very much at copper right now. Copper is usually derived from investments into construction and electrification, etc. And we've seen some very, very interesting moves over the past year. We had a big hike last year when China amassed a great stockpile of copper. We're still not quite sure why that was. Were they expecting some construction boom? Was it a strategic move? We don't know. What we're seeing right now is that at least for now, we know that the tariffs are going to be more sectorial than reciprocal. We started out with tariffs being about fentanyl and political purposes. Then it was this reciprocal thing, and you had that ChatGPT formula. Now we're back to sectorial tariffs. So I think we might see quite significant tariffs on something like copper from the US. Right now, if you try and calculate the tariff risk premia from the physical market to the futures market in copper, it's about 10%. I think that could very, very well be higher. So those are the kind of analysis that we try and do. The overall demand picture for copper is relatively strong. So our models are flagging copper as an interesting trade. And there's also this tariffs angle to it that's very, very interesting.
More specifically, how do you trade this?
Usually in the forms of futures in the copper market. You could go in the way of ETFs as well if you're not a professional investor. Could be looking at copper constructors as well, but there are some options in the investment space for that.
All right. Any other commodities or sort of industrial use cases where you see a lot of demands picking up?
Well, One that can be a little bit tricky to trade is uranium. Trump has announced a huge investment package into nuclear power. Nuclear power is a huge thematic in Europe. A lot of countries, especially Denmark, where I come from, we're realizing after spending 30 years building wind turbines that they're very good, but only when the wind blows. And the same goes for sun. And you know also, especially here in Finland, today it's raining. Sometimes it's sunny, but not that much. And we need to have a system for when the wind doesn't blow and the sun doesn't shine. And so in Denmark, we've been blessed to be surrounded by nuclear countries, even though we've been too holy to have nuclear power ourselves. But it's a very big thematic now. And Denmark is an example of what's happening across Europe. Reacceleration of investment into nuclear. We're seeing that in Asia as well. That nuclear simply works very, very well in conjunction with renewables, especially solar power. So we are seeing an increased demand for nuclear. That means a very big increased demand for uranium. Secondly, there's a big chance that an upcoming U.S. sanctions package on Russia, we can get back to the rationale on that, but if Trump decides to move forward with sanctions on Russia to pressure them in Ukraine, there's a good chance that it will involve uranium. Now, the U.S. doesn't buy too much uranium from Russia or Kazakhstan. They get most of theirs from Canada. But France, for instance, they get almost all their uranium from Russia still. And it's very possible that you will have these secondary tariffs or joint tariffs from the EU and the U.S. on something like uranium. So which again will drive up global prices. So there's an overall long-term increase in demand for uranium. There are these short-term effects from tariffs, so that is a very, very interesting case. Could be expressed, it can be a little bit tricky to invest directly in the uranium price, or could be expressed via uranium producers.
Okay. What about other commodities related to, for example, electrification of transportation? Do you see coupled lithium and these type of commodities?
Yeah. Obviously, the demand for them is great. The thing is, in Europe, we're trying to find sources of these materials, but they all have to be processed in China. So it can be a little bit tricky to get into the right investments unless you want to dip into the Chinese stock markets on this. So in the short term, we're not seeing huge upsides in those, so they're not flagging in our data models as short-term trades. In the long term, yes, we are going to see increased demand for electrification across the globe, not least driven by the EV market. So we know China are shifting heavily towards EVs. A lot of countries that have limited distribution of cars or limited users of cars, they're going to jump straight to EVs. And that's going to put huge loads on electrification. So yeah, it's a very good long-term thematic, I think.
How are your data models tracking all of this? How are you actually building up a new investment hypothesis, and how are you testing this?
So our investment strategy is very short-term focused. What we do is that we have nowcasting models, not forecasting, but nowcasting models of growth and inflation, and we measure liquidity as well. Those are the three key variables. On growth, we try to use sort of non-standard data sources. So obviously you have growth reports from central banks or statistics offices every month or quarterly, what do you have? And we try to gain a time advantage on that. We do that by employing data sources like pollution data, congestion data, box offices, flight data, all those sorts of data. We run them through a back test to find out how well do these explain movements in growth, and we have an entire data model for that, and that allows us to be very, very precise. At least a little bit more precise than markets. That's the whole point in nowcasting growth. So we get a picture of, is growth heading up or down right now? And it can be very, very subtle movements in that, but that is enough to gain a little bit of an edge, and that's what we're trading. To give you one example of when this doesn't work, a few months back, you had a I don't know what it was called, but it was a tariff or toll for entering Manhattan by car. So you had a payment ring around New York, and that caused obviously the number of and we used the traffic data in and out of New York as one of the data points, and that dropped significantly from one day to the other. And our data models flagged this as a huge recession in the US. I mean, pandemic-like levels. Yeah. And we said, okay, wow, what's causing this? Are we really heading into crisis levels? And then we see, okay, this is that very data point, and we know, okay, then it's going to take our data model 3 to 5 days to adjust to that. And then we're back to a level where it can actually spot trends, because it is very much looking at trends. So, I mean, that's an example of how this works, and why you also obviously need a human decision layer on top of this, because sometimes there are idiosyncratic factors to affect this.
All right. What is currently sort of the level of human interaction versus AI models, or more specifically machine learning?
So what we do is that we have each day we have our data. We have these 3 nowcasting indicators. They paint a macro regime for us to say, okay, now we're in gung-ho territory, or QT or QE-like territory. And then we run that through historic data and try to find what are similar patterns. When did we have similar situations in global macro within 1 or 2 week spans? So it's relatively short term. And then we say, okay, we know that this macro environment happened at these times and points in time. What is then our expected return from a historical standpoint? And that allows us to generate expected returns on each asset, volatility adjusted, etc. So our data models simply every day prints out a top 10 or top 20 list of these are the trades I would look at right now. And then we go through that, say, okay, do we have some idiosyncratic reasons? As I mentioned, the congestion toll that has some effects, could be political factors, etc. And then decide the trades upon that. So we have a very, very structured process of generating trade ideas, but the decision is all human. That's how we approach it.
All right. So you're evaluating these potential trades fed to you by the algorithm on a daily basis?
Yes.
How long or short is the sort of a trade window or open positions?
It can be from day to day. Usually, most of our trades on macro trends are couple of weeks to a month, 2 months. That's the usual time frame. But we do have some more value-oriented trades that can be intraday as well. So, and sometimes we can flip. I mean, right now our models are telling us to look at being long the dollar, which is contrary to what we've been the entire year. That's most likely a very, very short-term signal. But that's then we evaluate. Okay, are we there yet? What's the price action? How are we looking in markets? So it's a very structured approach to making sure that we are not reinforcing our own biases, but that we are constantly challenged and constantly been made to see, okay, the data tells us this. You decide whether you want to trade it or not.
All right. Can you still sort of break down the logic of the algorithms, or does it occasionally feed you some kind of strategy and you have no clue where it came from?
No, we can always deep dive, double click on it to see, okay, what's actually driving this. And we also always measuring and calculating our conviction rates on this. So how sure are we of the signal? And the stronger the signal, the more risk we allocate to that, obviously. So obviously we always do that, especially when it's a very, very strong or contrarian signal. We say, okay, are there some data things that we need to look at here? And take it from there.
All right. In terms of a portfolio construction, how are you looking at it?
So we're a hedge fund, so we need to be a hedge in people's portfolios. We take that very seriously. So our aim is not to track the performance of the S&P 500. Rather, we would like to have steady performance even when it's not performing. This April was an incredible case for us, cynically speaking. When you had massive drawdowns in the S&P 500, we were able to make a steady return, and that's what we want. So we are. As I mentioned before, we take a lot of trades. Some of them are very, very short term, but we always have very, very tight stop losses policies and very, very tight risk management to keep the drawdowns very, very low, because that's the nature of our product. We're not aiming to make 50% returns when the markets go crazy, but we're aiming to make steady returns of 10 to 15% with very, very low drawdowns. So that's the nature of the product. It allows us to be, at some points, like this April, the only green in a sea of red in people's portfolios. At other points, people might be disappointed that we're not getting the same returns as the Max 7s when they're going through the roof. But that's our game, essentially.
All right. When did you come across crypto? Is that part of your investment strategy, or?
It's not, and that's mainly for legal reasons. We do have some proxy bets into it, but not the way we don't trade crypto. It's very, very tricky to get around compliance and legal obstacles when doing that. So you pretty much have to make a decision about, do you do crypto or don't you do crypto? And for this product, it made sense not to. But personally, I'm very heavily invested in crypto. We're very interested in it. We do a lot of discussions on crypto, and we are looking to make fun products around crypto in the future. Absolutely, because it's such a huge theme, and I think overall for me, I've also been a skeptic of crypto. But what changed my mind was two things. One is that I've always feared that there was some kind of tail risk that crypto could just collapse and be worth nothing at all. Not that it was ever very likely, but there was some kind of tail risk that we all misunderstood this. It's happened with other things before. That tail risk is, in my view, gone. It's been handled. It's been mitigated. Why? Because a political safety net has been pulled out under crypto. You have politicians from both sides of the aisle in the US. You have major institutional money. You have major governments holding major levels of Bitcoin. That's only increasing right now in these months and years. So in many ways, from an investment standpoint, crypto has become too big to fail. You could then argue from a philosophical or ideological standpoint that that's exactly what Bitcoin tried not to be a government asset like that. But I mean, from an investment standpoint, to me, it cuts out that tail risk. The second thing is that the one case for crypto is obviously that it's a debasement bet, that it's a bet that it can step in as digital gold, etc. The other thing is that it has a very, very real application value. And that was made very clear to me. I hosted a podcast, I was books that I host with Visa, MasterCard, and the main Danish provider of payment solutions. We talked about digital payments, Apple Pay, etc., all that. And then I thought by the end, okay, I'm going to hit them with a crypto question, and they're going to be unprepared for that. They're not going to know what crypto is. And I was swept away. They were, these were like boomer country managers. They were 55, 60 years old. I think they were completely on top of that. They were just awaiting government action to tokenize everything they have and throw everything at crypto for payment systems. And that's $1 trillion industry, if you look at it. Yep. So to me, that shows me that if you cut away that tail risk and you have that supporting case that crypto in some shape or form is going to take over the payments industry, that just makes it an incredible trade for me.
From crypto, just mainly referring to Bitcoin, was the ETF approval sort of one of those big stamp of approvals that sort of validated the case for you? And on the payment side of things, stablecoins seem to be the first real product market fit. Absolutely. I think the ETF approvals and started sort of a snowballing of institutional money driving into crypto. It's been ongoing for several years, I know that, but it's snowballing now, and it's getting political as well. And that's obviously key because that opens the floodgates for so many investors who have been holding back. You still have major banks holding back on crypto in many ways, but you have family offices, hedge funds, governments, sovereign wealth funds looking into crypto now. And that's just an amount of capital that can only drive up prices, in my opinion. Compared to the previous cycles, because crypto seems to be very sort of cyclical, almost like clockwork. But compared to previous cycles, I think this one is slightly different. So we have the institutional capital inflows. Suddenly there's BlackRock and all the major players sort of pro-crypto. Like you said, the regulatory sort of safety net is now there. You have ETF products there where you can get exposure, even though it might be the direct exposure to the underlying asset might be outside of your mandate, but you can still buy these sort of ETF type of products. Do you see this as a significant sort of a driver for future growth? And the original hypothesis of Bitcoin as sort of as an inflation hedge, or maybe more so monetary debasement. Do you see this as a sort of a value prop? Because historically it has been correlated with the Max 7 and all the tech stock and the risk assets.
Yeah, and I think probably it's going to be even more related to bond yields now. And I think that's one of the main cases that people are beginning to that it's an anti-inflation bet, and that is going to be a major topic and a debasement bet. So absolutely, I think all the things you mentioned just strengthens the case. I think we're not at the FOMO zone yet of this cycle. We're going to get there when we get solidly above 110, perhaps. I don't know what's going to be the top point, 130, 150. I don't know, but there's a lot of thin air there. There's still a lot of FOMO effect missing in this cycle, I think, that you're going to get. And we'll see how high and then how low it goes, because we are going to get those cycles, obviously.
Yep. And I think also sort of historically it has been quite strongly correlated with these larger inflows. There could be theoretically a time when it decouples from the global money supply, basically.
Yeah, that's the hope. I mean, I think the cycle we saw back in November, December, January was obviously partly driven by the expectation that the US government was going to invest heavily and throw money at it. That hasn't materialized. I think that's something that a lot of players and a lot of actors in the Trump administration wants, but it's still a bit too complicated for them. And I mean, quite frankly, they're not in a position to spend more dollars on that, as is how they would see it. So that's still in the future, to have a true Bitcoin reserve and building up and buying. But it's slowly getting there. At least now you're having governments, whenever they seize Bitcoin, they're keeping it. I saw a statistic that governments are holding over 2% of all Bitcoins. That's quite a lot. And they're holding it down. They're not pushing it onto the markets or flooding the markets with them. So we are seeing those strategic shifts. It might be one or two presidencies away from a true Bitcoin reserve. But I mean, in the US, it's a huge voter base as well. So it's become too big to fail. It's becoming a government instrument. And it might be part of the solution to the deficit as well. So, I think the case is super, super strong. And, it's going to have ups and downs, and you're going to have you got to have the stomach for that. But if you look at it long term, I'm finding it very hard to find counter arguments.
Yeah, and in Finland also, it's becoming a significant voter base. I think there's over 500,000 crypto owners these days in Finland, so it's almost 10% of the population, probably closer to 15% of the voting base. Mm-hmm. And if you look at the previous US elections, I won't say it was the deciding factor, but it was significantly at least moving the needle.
Also because you have, I mean, it's becoming more and more convenient to buy Bitcoin. It become much easier. So essentially, bets like a MicroStrategy is essentially a convenience trade, because it's a way for people who don't want to meddle with wallets or get into Kraken or whatever. They can buy that stock and that's it, and they're essentially invested in crypto. So that also adds indirectly via proxies money flows into crypto. So, and it all adds to the overall equation of and the overall case, in my opinion.
Well, what do you think about this new trend of public companies buying Bitcoin as a treasury asset?
It's strange. I'm still getting to grips with it, but in my opinion, it's a convenience move. I mean, they're making it convenient for people to buy Bitcoin, which is essentially still holding a lot of people back, because they don't feel it's safe. They're not. It's not too transparent for them. It's much easier for them to go onto their online bank or their whichever broker they're using and buying a stock. They know how that works, and when you can buy crypto as a stock in that way, it makes it a lot easier for them to do that. So for me, it's a convenience thing. Very, very well spotted as a trend. Brilliant idea to do so. I think in a couple of decades we're going to laugh at that probably, but I think for now it's that's always my case if I look at private equity or startups or whatever. If you're selling convenience, then you're in a good place, and that's what they're doing right now.
Yeah. Something that I'm still trying to wrap my head around is that why, for example, strategy is trading continuously, let's say 2, 3, 4 times the NAV. Mm-hmm. So you have a huge premium in relative to their Bitcoin holdings.
Yeah.
Any thoughts on why this is?
Well, it's difficult to justify in the long term, I would say. But again, it's the expectations that others are going to use that as the way to get into crypto. So it's kind of like betting on Coinbase, in my opinion. So it can go on for a while until people become more and more familiarized with investing in crypto, I think. People want convenience.
Yep. And I think you saw sort of a similar trend with the Circle IPO now.
Completely.
Totally oversubscribed. It shot up 140, 50% or something like this, and they had to halt the trading through the volatility.
Yeah, absolutely. So, I mean, it's everywhere you look, it's people are betting heavily on crypto. We'll still have to wait and see exactly which platforms, which blockchains end up on top of it. But at the end of the day, much of it ties back to Bitcoin, of course. So yeah.
Yeah, and that's definitely a hedge against monetary debasement. Exactly. And then you have all the other platforms doing the smart contract stuff where you can start actually looking at the aspect of programmable money.
That's exactly where I see it. And I'm that's exactly how I see it. So Bitcoin is the, in lack of a better word, the best bet on the digital gold agenda. And the other things like ETH, Sui, Solana are probably going to be the ones taking over the payments market. Which one of them? I have no clue. But I mean, as long as we're not materializing and implementing this yet, we're very close to taking broad bets, and these are very, very solid bets.
Yeah, and it does bring in some efficiencies in terms of how markets work. Because if you look at what Latterfink was saying about tokenizing all securities, it seems quite obvious. You had 24/7 market, instant settlement,
completely
everything happening transparently on a smart contract platform.
And you have a lot of government applications for that as well, both in confirming house sales, all the entire confirmation security and government systems, also in military. I know the US military is looking very actively into tokenizing their supply management because they're spending enormous amounts of money on managing and monitoring where their supplies and material is going. It's very, very logical to tokenize that. So there are huge applications. The main one for me that's very, very logical and almost inevitable, because the US military might find some other technology to do this. We don't know. But the payment system, I think it's almost inevitable that is being tokenized right now. And I think that's going to happen on a very, very large scale over the next 10 to 15 years. And that gives me again, when you look at the tail risk of cryptos, I mean, if you get that's $1 trillion industry. If crypto is the basis of $1 trillion industry, then it's just a matter of where does the money flow. You're going to make money off that. That's inevitable, and it's going to be worth so much. Even if it's obviously the point of that is that it reduces the cost and of payments, but it's still a huge industry. And so to me that's sort of the bedrock of bets in ETH to Solana, obviously, and makes it almost a no-brainer.
Do you have a sort of plans in the future to include crypto? You mentioned you have currently a fund where it's outside of the scope, but
I mean, it's not going to be in our current fund setup. It doesn't really necessarily fit that too well. But yeah, we at some point it's going to be inevitable to include crypto at some level. So yeah, we would love to. It's very interesting. It's still tricky from a legal and compliance standpoint. You cannot run a fund without working with banks, and then for them it's always tricky to manage with crypto. Yeah. But it's a matter of time to solve that. Again, probably in a way also to offer some convenience, because crypto is also being democratized is the wrong word, but it's being adopted much wider in the population, also much wider than what most people realize. You mentioned the statistics on Finland, and I don't think it's that widely used in Denmark, also because we have a relatively anti-crypto government, to be honest. But it's being adopted much wider than what people realize, and that drives that whole development, absolutely.
Yeah, and if I'm not mistaken, I think it was somewhere around 300,000 crypto owners in Denmark as well, so it's relatively big.
I heard the statistic as well. It came up recently because the Danish government tried to change the tax rule to make it what's the word for that? But I can't remember the word for the taxation, but they tried to do that with back-reaching power as well. So hopefully they're going to change the course on that and to signal that Denmark is more open to crypto. But it's still, I mentioned that governments are implementing crypto. It's still, if you go into the government offices, the bureaucrats, they have no idea about crypto because it's very, very tricky for them to get a grasp of what it really is. So there are still a lot of dogmas, a lot of barriers to break down, but it's going to come within the next 5 to 10 years, I'm sure of it. And that's why there's still some edges to. It's still early in the sort of long-term cycle here.
No, I think they're still wrapping their head around the idea of Bitcoin, stable coins, which is sort of relatively simple, and then you throw them into the whole smart contract, programmable money type of thing, and that's sort of when all the wheels come off.
Absolutely. Yeah. So you still have a very big window for that, and when that happens, when that adoption happens, it's going to massively increase the price of crypto, in my opinion.
Will your current strategies and algorithms be applicable to the crypto markets as well, or?
Yes, we're working very actively on that. We believe so because there are a lot of correlations and a lot of causality between, that's the right word, between macro indicators and crypto. Absolutely. We're still working on that, to be fair, but it's something we're very much looking to leverage our data models for in the future, because they have a strong explanatory power over all kinds of assets. So why not digital assets?
Yeah, with the on-chain data, you could probably make them even more efficient because you have so much publicly available data.
Exactly. It's a very data-heavy field, a very accessible data, so that makes that job a lot easier. So it's a matter of making sure that you have the right causalities, because a lot of those causalities are shifting as well. But it's the way to go, in our opinion.
Yeah. To wrap it up, maybe you can give the audience sort of a broad, maybe a little bit positive sort of outlook. The markets are going up or down? Are we still sort of, despite all the uncertainty and global conflict and crazy presidents, Russian sanctions and all this other stuff, do we have some hope with the markets, or?
I think so. I think for markets, the tariffs discussion is almost over. I mean, you're going to have some deal with China that's going to create a little bit of ripple effect, but it's mostly going to be like a smaller kind of deal because I think Trump wants to get this done. Then we're probably back to having some tax cuts that's going to inject some money into you're going to have improved liquidity most likely. So I think manufacturers are we can hopefully soon put this tariffs discussion behind us and all the drawdowns we saw in April behind us, and I think we have a quite benign growth picture and quite benign picture for equities throughout the year. That's our base case at least. Might change. We might get something else. I think I thought that the geopolitical risk would drop more under Trump, because usually you have an effect of a new president, especially Trump coming in with a very, very strong mandate. It's essentially his second term, so he has a lot of experience, should have. So I thought he would be able to end some wars, as he promised to do. He hasn't been able to. He might have done some deal with the Houthis in Yemen, but it's not really ending wars. There's still war ongoing in Gaza, still war ongoing in the Ukraine. We're not getting anywhere close to the solution that I thought we would be close to, in all honesty. So the geopolitical risk is still there. That could have been another boon to markets if geopolitical risk fell. On the other hand, you do have the lowered oil prices. You do have a lowered US dollar, which is helping the global growth picture, I think. So you have a lot of factors moving in that direction, at least for the scope of 2025. Yeah,
and I think maybe those conflict-related variables are already priced in. They've been ongoing for so many years that it's sort of, it's still ongoing.
Yeah, so my hope was that a peace in Ukraine would sort of puncture the risk premium surrounding that, and as well with some kind of solution in Gaza. To me, it doesn't seem that Trump currently has he was too ill prepared for this. He probably lacks the political stamina to really keep working on these topics to solve them. So I think he's going to try and find some ways out of these discussions, maybe make some limited deals or say they're going to handle it themselves. And then he's going to turn his attention towards domestic policies in the US. We heard, I think it was Pete Hegseth, the Secretary of Defense, who summed up sort of the Trump agenda, which I think is going to be, and that's nothing to do with geopolitics or the global agenda. He's focused on cleaning up the streets, get men out of women's sports, and no more dudes in dresses, as he said. and you can agree to disagree with that, but I think that is going to be the agenda heading into the midterms. Much more focused on the domestic issues. Also, the fourth one could be to rain fire on Harvard and all the Ivy League schools, because those are agendas where Trump has huge support in the population. It's much easier for him to claim wins there. Harvard is a much easier opponent than China. So it's much easier to fight a war against Harvard than to fight a trade war against China. So I think that's going to be the focus for the next year.
I think you could, if you could actually tax the endowments, you could probably make a decent dent in the budget deficit. That
would certainly help. I think long term, I don't think it's positive for the U.S. economy that you force away. I think international students. I mean, it is a huge boon for the U.S. that everyone wants their best and brightest minds to go and study in the U.S. That is a boon to the U.S. economy, no matter how. I mean, every other country on earth would love to have just a sample of all these students coming to their universities. And if they try and push away the international students, other countries are going to grab that up like candy. I mean, they're probably going to go to Singapore, Dubai, Switzerland, whatever. They're going to be investing heavily in grabbing up all those international students. So, I mean, it's a political move. It's very, very popular in the US, most likely. So, I think that's going to be the focus. But I don't necessarily think it's very good for business, to be honest.
For the listeners, where can they find more about your insights and research at the Steno Research? Any other venues?
Look up Steno Research for our research offering. Look up Steno Global Macro for our hedge fund. Otherwise, follow me, Rosenvald Geo on X. Andreas Steno as well on X. He's our CEO and CIO. So lots more to be found there.
Yep. All right. Thank you so much, Mika, for being our guest today.
Huge pleasure to be here, and thanks for the time.
Thank you.